you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Tom Stevenson from Fidelity. Hello, Tom.
Hello, Emma.
So we've reached the part in our retirement special week where we're looking at what investors are doing, what retail investors on the street are doing post-retirement. So what are people doing?
Well, it's quite early days. I mean, we've only had a week and a half since the new rules came into effect. So we've had a lot of phone calls. I think most people actually are phoning up just to find out what their options are. What the new rules mean for them. But people can now take out their money, and we have seen some people take out their money. A lot of those are people with just very small pots, and that makes sense really, because if you've got a very small pot, there's not much point in investing it for an income because the income will be very low. You might as well take it and enjoy it. At the other end of the scale, we've had one investor who took a seven-figure sum out. And of course, they will have paid quite a big tax bill on that. And that's one of the considerations that people need to bear in mind is the tax if you take a big lump sum out of your pension. Now, in this particular case, it didn't matter to this investor because he knew he was going to be a higher rate taxpayer, and whether he paid 45% on his lump sum or 45% on his income really made no difference. So a variety of withdrawals we're seeing.
So let's take a step back, because of course these pension changes don't just affect people in retirement, they affect people saving for retirement because goals have changed. You no longer have to buy an annuity. So where are you seeing in the inflows for people investing for retirement? Yes,
and indeed people investing for retirement are investing before they retire and after they retire, because what we're finding is if you can take your pension pot when you're 55, then the chances are that you're going to live for quite a considerable time after that. So anyone investing around retirement or post-retirement needs to think about both an income, but they also need to think about the potential for capital growth so that they can maintain the real inflation-adjusted value of their funds. And actually, we're seeing that reflected in what people are investing in. It's a mixture of funds for income and funds for capital growth.
I think it rather skews traditional portfolio theory, doesn't it? The whole concept, both for retail investors and institutional investors, that as you approach your retirement date, you should sort of, come down the risk scale and streamline your investments, flight path. There's all these sort of buzzy words, which basically mean out of equities into bonds.
That's always been the conventional wisdom, hasn't it? That as you approached your retirement date, because you knew that you wanted to use the money to buy an annuity, you wanted to protect the value of your pension pot as you came to that date. So you de-risked the portfolio. You moved into cash or into safer bonds. When people are investing on a 30-year timescale, even at retirement, they need to think a bit differently. So they need to think about investing for growth, so that they don't get caught out by inflation, because over a 25, 30-year period, inflation can wreak real havoc with your capital if you're not careful.
Having said that, that doesn't mean there's no longer a point or a position for cautious assets within a retirement portfolio, because of course you are more dependent on a regular income in retirement because you don't have a wage.
No, that's right. And I think an approach that some people are taking, which is quite sensible, is that they do a bit of a mix and match. So they will annuitise a small proportion to cover their basic outgoings, and then they will invest the rest for a mixture of supplementary income and capital protection as well. And I think that's a good approach.
Tom, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.